So a lot of traders, once they've experienced one or two unfortunate liquidity grabs, that's when they quit, or that's where they have this fear that sits in the back of their mind every time they see one. However, liquidity grabs can actually be a good thing if we just know where to spot them. So in this video, I'll be going over how to do that, as well as how to take advantage of them in trading. Alright, what's up you guys? It's Matt. In this video, I wanted to go over an interesting topic, which is liquidity grabs, or as some people like to call them, liquidity sweeps. But I'm just going to use the term liquidity grab. You might also hear the term stop hunt or fake out or stop rate. It's all the same thing, just differently worded. And so we're going to be on the euro, and we're going to be doing a case study of liquidity grabs, just so I can kind of show you guys a point that I want to get across in this video, which is how a lot of traders make the mistake of just assuming because the market is maybe not super easy, trading is definitely not easy, and liquidity grabs do occur quite often, they'll assume that the markets are out to get them and that they should be afraid of liquidity grabs. But the thing about trading actually is that if you can spot or anticipate liquidity grabs, you will find that liquidity grabs actually enhance or improve your trading, because now you can actually use fundamental news events, or with the anticipation of liquidity pools that the price is going to tap into and then reverse, you can place yourself in some pretty good positions. Here we have 2 weeks worth of data marked out, and we are on the 2-hour chart. Let me actually drop down to the 1 hour. And so we're going back 2 weeks. And the reason why I brought this up is because it's a pretty good structural example here on the euro, right? So we have 2 weeks worth of data, and initially we can see that the price is pretty bullish. Then maybe for about a day or two, we're going sideways, but gradually over time, we're continuing to go down. Right? So we have this model of where, notice how at the start of the week, so following Friday, we can see how the price created these 3 peaks. And I'm also going to be marking out the lowest low that was formed in between each peak. In essence, if we look at this, this is roughly a channel. And channels are not really used much nowadays, at least, especially not if you're in the smart money space, maybe if you're in the technical pattern space. But essentially what this is it's a range, but with a little bit of a slope. So you could look at this as representing a gradual or slow range that's going to turn around. I like to use channels, or some people like to use wedges, as pretty much anticipating when a liquidity grab might form and when we're going to reverse. Because if we think about this entire section as a range, for the most part, it's quite balanced. Right? We don't have any crazy imbalances here. Now, every now and then we do push up. So that's this first peak, we pushed up and we matched the previous peak right around 1.18 or 1.18. Then we dropped down. Gradually, we pushed up, created another higher low. And then that's where we would have had this fair value gap here to the left. Here we can see where the most extreme imbalance, I should say, roughly resided between 1.184 down to about 1.1815. I know this might seem a little bit confusing with all these lines. Let me just mark this out for you guys. Right, so this would have been your ideal fair value gap, as the lower one already got tapped into earlier. But additionally, if we just look at it in terms of what was occurring previously, we were creating these gradual peaks. But notice how I didn't mark out this peak over here. This peak over here was essentially like an equal high, if we think about it. From Monday to Wednesday, the start of the week, we were bullish, and typically the middle of the week, you'll encounter reversals on Wednesdays or Thursdays, majority of the time, what I find at least. Now, what time did this occur? Well, again, we're on the euro here, and this occurred at 2 a.m. Technically, 3 a.m. is where we reached the highest peak, and that's at London's open, right? We pushed up, large aggressive push that pushed us above this channel. See, this is how now I'm pretty much looking at this channel and looking at it from the reverse standpoint, right? You're pretty much going and playing a contrarian by going against the pattern that the price was previously in. So that would have been a trap in a lot of cases for a lot of beginners, especially who use channels and trend lines and everything, which if you're just constantly looking at it as, oh, the price broke out of a channel, time to buy or time to sell, you're not looking at it from the lens of liquidity grabs, because that's what we're going over here, right? Liquidity grabs, you basically have to look at this as institutions are looking to place their orders. They place large orders. Their orders move the markets. They can't just sell inside of this range. One, they're not going to be able to place a lot of orders because if they do, the price is going to quickly drop down. But two, I mean, institutions, just like we are when we go to the store, they don't want to pay the most amount of money if they don't have to, right? They want to sell at the most premium level, or they want to buy at the most discounted level. And let's keep in mind that it's not just institutions trading against us, the retail traders, the poor retail traders, right? It's institutions also trading against other institutions. And so that's how competitive trading actually gets, to where we're just the little fish swimming in the pond trying to catch up to the sharks. So what happened? Well, this is where the price pushed up. We tapped into this higher time frame fair value gap, as I mentioned. So 250 round level, I usually find gets targeted, just like 500 or a bunch of zeros. Typically, those are like magnets. But more importantly, right after this, the middle of the week, we tapped into that and then we dropped down. So by looking at the structure and us anticipating, because the price is creating these gradual higher lows, and now we have these equal highs, and we're also about to tap into this higher time frame bearish fair value gap, we can position ourselves in the direction of where the market, especially because it's the middle of the week, right, where the market is more likely to head towards as we're pushing higher and taking advantage of the fact that we're most likely going to get a liquidity grab. And by anticipating that, we can place an order in a good position. Hindsight 101, but one position would have been the London session as soon as it opened or after it opened. As soon as you see the price spike up above these equal highs and then close back down below them, that's usually a sign that, okay, now we've pretty much swept the liquidity here, tapped into this liquidity pool, and now we're going to start pushing down, right? So that's where you can position yourself in one trade, right? And then your stop loss would be near these peaks. Because if we think about it logically, if there's a liquidity grab, why would we return to where we had a liquidity grab if it's a liquidity grab? You know, if we think about it, it doesn't really make a whole lot of sense. And that's because if institutions placed their orders at the best levels, they're not going to want the price to push back to those levels and then they have to close their orders, right? They haven't even taken profits here and they're in it for a while. Why wouldn't they, right? If you had a swing trade being held for 2 weeks, going short and the euro is dropping, right? And you have fundamental analysis and data especially, and millions or billions of dollars to trade with, are you not going to hold on to it? Yes, you will. And so liquidity grabs aren't there to scare us off. They're there because that's simply how institutions place their orders. And you can take advantage of it by positioning yourself in the direction that they're going in. Now, granted, if you can't hold on to a trade beyond the daily close, let's say you have to close your position by the end of the session, that's fine. This is still a trade that would have been worth taking. Now, realistically, let's say you didn't trade the London session, because this is the euro. Some people wait for the New York session. That's totally fine, right? As soon as the liquidity grab plays out, you pretty much can position yourself for your daily bias, right? You know what is most likely to play out for the remainder of the day, and honestly, even the remainder of the week, and sometimes even the following week, depending on fundamentals and how big of a liquidity grab played out. And I rewinded this back just to see what it looked like, right? Let's say that it's Wednesday morning, New York sessions morning, and all of a sudden you see this spike where the price is pushing up again into the top of this channel, right? Following where we had this liquidity grab. Well, one, it's likely due to fundamentals, especially at this hour. But even just technically speaking, we're still holding this level. And so because the price is still holding this level here, so where we had that liquidity grab, because that's still being held up, there's no reason to exit right away. As institutions still have some orders here, And they also have more orders that are being placed as the price is pushing up right over here, right where we have this bullish candle and these upper wicks as well. So the best rule of thumb is just play it by probability. I find that traders out there, even those who aren't beginners and know that liquidity grabs and trading in the direction following liquidity grabs is beneficial, I find that they still fear taking those trades or reacting to liquidity grabs for one good reason. Well, technically, I would say there's more than one, but fear and stuff like that. But psychology aside, I think the biggest reason, did that make sense? I think the number one biggest reason why comes down to poor risk management. They are trading with, and if you do this, that's okay, right? That's totally fine. You just need to learn to manage it a little bit better, but they are probably trading with a very tight stop loss, or they're afraid of slippage. So slippage being you're in a trade, your order doesn't get filled right away, doesn't take you out right away. And so you end up taking a bigger loss when there's a strong impulsive move pushing against you. So a lot of volatility can sometimes lead to slippage, especially if you're trading markets that don't have a lot of liquidity. It also depends on your broker, but you shouldn't be scared of this, right? You shouldn't just look at this as, hey, it's a bullish candle, it's going against me. You look at the overall market, you're doing a top-down analysis here. You're starting on the higher time frame. You're looking at the direction, the overall context of what's happening. You're seeing that the price is simply retesting this cluster block here, which is a resistance zone, or you could look at it as the top of a channel, and you're just seeing this as a good likelihood that the price is simply creating a lower low, a lower high, and it's going to be confirmed. It's going to be a confirmed market structure shift off of the hourly or 15-minute if we then push below this low, right? Because if you look at this as the price is either in a channel or in a range, if we're looking at this as a period of consolidation, once we break below that, then we're going to continue pushing lower. Notice how it also took out this 4:30 a.m. high, and that typically happens sometimes. You might have a liquidity grab, and then the price returns near that liquidity grab, just for institutions to be able to place more orders, and then you get a large wick rejection, or it sweeps a shorter term high or low like it did over here, right? So it didn't sweep the highest high, but it swept the second highest high. And then what do we get? We got this strong rejection, and then the price following that consolidated for a bit. You just have to be patient. And at that point, it's a marathon. It's just going, right? All the racers are on the front. They're just going. You're either in it or you're not. And if you're not, that's fine. You could join the race later on, but you're not getting as many laps in, which doesn't mean, I'm not saying to be greedy, but that's the advantage when it comes to liquidity grabs. If you can anticipate them and treat them as maybe not your best friend, right? Institutions, markets, they're not there to hold your hand and sing about how great it is to be a trader and how you're going to be a millionaire tomorrow. That's not what it is whatsoever. But they don't have to be your enemy. You guys can be neutral. You can be chill, right? We can be chill and just go from there. That's all for this one. Let me know what you guys would like to see next. Like this video, of course, if you enjoyed it, and have a nice day.